Hello, my fellow investors. There are three different ways a human being can earn money. One is being an employee. This path of income is based on the human factor only. The person doesn't need money to get their income. It's just their work that they're doing is generating their income. The second option is the exact opposite, and that's investing. And this option, the money is generating money, and the human factor doesn't exist, besides the decision to invest the money. Now, in between these two opposites is something in middle, which is business, where someone opens up his own business and he's employing himself. And this kind of income is a combination of the human factor and the monetary factor. The person needs to work and he needs his money to build his business. Together, he generates the income. Now, all the advantages of value investing versus speculating that I'm going to lay out in this video is rooted in this issue that value investing is exactly the second option where the money is generating money, while speculating is more of a business than true investing, since speculating requires the human factor to constantly work and direct the capital to generate money, while value investing, you're just putting the money in a value and letting it grow. Now, I started my investing career as a pure speculator, and then I turned into a mixture of a speculator and a value investor, and today I'm a pure value investor. I think throughout the years I've learned and seen all the pros of value investing versus speculating. And I must say, hands down, value investing beats speculating in a lot of aspects, as I'll explain soon. But before I get into all the advantages of value investing over speculating, I just want to point out that not all the issues that I'm going to explain soon apply equally to all people. And it can vary a lot between people depending on the character and the different things. And that's also why some points will seem to be duplicates, but actually they're not, because some issues apply to one person in a certain perspective, and to another perspective, to another person, it would apply in a totally different way. Okay, so let's get into it. Advantage number one. As I pointed out, in value investing, the money is generating money, while in speculating, the human factor is needed to constantly generate money. And therefore, value investing has an advantage that your money, if invested correctly, is compounding for you much more than in speculating. In value investing, you can invest one time, and for years your money is compounding and generating money, and you don't need to do anything. While in speculating, you need to constantly work to generate revenue. So this is one advantage that value investing has over speculating. Advantage number two. In speculating, you need to constantly work to find a good investment. No matter if you're trading stocks or derivatives, or you're a day trader or a short or long-term swinger, whatever it is, you need to constantly be on the lookout for good speculation. On the other hand, in value investing, you can literally sit in the entire day in a couch in your pajamas, drinking a cold beer while doing research, and you can do great. Because it's once in a blue moon that a great company's stock price would crash 50% in one day and the next can go back up. So usually when a good value investment opportunity presents itself, you have months to sit down and analyze the company and the situation, and there's no need to rush. In today's day and age of screeners, I'll phrase this advantage like this. In speculating, the speculator needs to chase after the opportunity. But in value investing, the opportunity is presenting itself to the investor. He just needs to be in the lookout to find it. Now, if you like this video, don't forget to smash the like button and subscribe to the channel. Okay, advantage number three. In speculating, after you buy a security, now I'm speaking after you bought it already, you're constantly on the lookout day and night. Is the market or stock price going up or down? If it goes against the way you anticipated, do you sell or average down? If it goes up, do you sell or wait for more gains? It's like being a watchdog for your stocks. You constantly have to watch over them. Now, even if you're not the kind of speculator who needs to check the market and the security stock price every other hour and get up twice in the middle of the night, you're still constantly on the watch. On the other hand, in value investing, the only time you need to work is once a quarter, when a new report comes out. Besides that, you don't really care about the ups and downs of Mr. Market. So I'll phrase this advantage like this. After you buy a security, after you buy it, in speculating, you're working 90 days each quarter. In value investing, you need to work only a few hours per security in each quarter. Okay, advantage number four. Things change and go wrong a lot more often in speculating than in value investing. Because every change in the market or in the stock price puts the speculator in a position where they're asking themselves, what's my move now? And they need to decide, usually very fast, what to do. And a lot of times they make the wrong decision. And they're in a pickle, maybe to reverse course, maybe not. And speculators live looking backwards a lot of times, and they're constantly in a regret on their actions or inactions. Did I do right? Maybe did I do wrong? Maybe I should do backwards. And that's why speculators tend to be much more stressed out than value investors. And this can be very bad for their health and a big disadvantage to themselves and their close family and friends. On the other hand, in value investing, there isn't a lot of change, since the stock price is hardly a factor. And the only issue is a change in the company's fundamentals. And this doesn't happen often. And even when it does happen, the investor has a lot of time to think calmly what to do. Advantage number 5. All human beings have emotions. Even a speculator who learned how to live calmly without stress, they tend to be more emotionally attached to the market. And this can cause them to miss out on a lot of things in life. So even if they're not stressed, but they're more emotionally attached to the market. And that's why they can go out with friends or with family, and instead of themselves and their friends enjoying, they're thinking about the market. They're in one place and their head is somewhere else. It's very hard to learn how to totally get detached from the market. But on the other hand, this is hardly an issue for the value investor, since the change in the market doesn't affect them. They don't care if the price is going up or down, the stock is going up. They don't care. The only thing they care about is the fundamentals. So why do they care right now if the stock price is going up or down? And they could go out and enjoy themselves. They don't care what the price is doing, what the stock price is doing. Okay, advantage number 6. Good investing needs a good strategy. And this applies both to speculating and to value investing. An investor needs to have a strategy, what's plan A, and what's plan B if they're wrong. They need to have a strategy, what's the entry and the exit point. And even in value investing, this is true, because let's say in a cigar butt kind of investment, or even other investments, in some cases, let's say they find a better investment, should they sell or not, they have to have a strategy. So it's much harder to have a good strategy in speculating than in value investing. Because in value investing, you know exactly what you're doing, what's your plan, and you know when to change course. What's your plan? You know exactly what your plan was. And in speculating, there isn't something very specific that you're planning. And a stop loss isn't a strategy. It's just a way of saying, this is how much I'm willing to lose on this bet. Okay, advantage number 7. In speculating, it's much harder to realize you were wrong. So I'm speaking about after you bought a security. It's much harder to realize, okay, I was wrong. I bought because I thought this and this would happen, and I was wrong. And why is it much harder to realize? Because you thought the market or the security is going to go one way, but you know nothing is going to be exactly like you drew it out. You know it's not going to be exactly a straight line. It's going to go from 1 to 110, from 50 to 69. You know it's not going to be exactly like that. So you had an idea in your head, but you didn't draw it out exactly. This is how it's going to be, and therefore it's very hard to come to realization that you were wrong, that you made a bad speculation. But on the other hand, in value investing, it's much easier to realize you were wrong, since the investment was based on the value. And now the new report came out and you see the numbers, so you know right away I was wrong. And it's much harder to come to realize, it's much easier in value investing to come to realization that you were wrong. Now, advantage number 8. Once an investor realizes that they were wrong, it's much harder for a speculator to take action and sell in a loss, since their investment was based on the market movement. And so you say, okay, they realized they made a mistake, but the whole investment was based on market movement, and speculators tend to cling to emotions and to hope that the market will swing their way. They say, okay, I know I was wrong. I thought the stock didn't go up, and at the end it didn't go up, but the market could still go my way. So even when they know they were wrong, it's very hard for a speculator to say, okay, I lost, I was wrong, I lost, I'm taking, I'm changing course, I'm selling. And I could say from experience that I think I lost more money when I knew I was wrong, and I knew I could make money changing course, and I didn't change course. I thought the stock was going to go up or option, and I knew if I'm going to change course right now and go the opposite, I'll make a lot of money. And still, I knew I was wrong, and it was still hard for me to come to realization. Now's the time. Sell on a loss, change course, and you'll earn money. But on the other hand, in value investing, the value investor bought their security based on valuation. And the second they see they were wrong, it's very easy for them to sell because they don't care about the stock price. The only thing they care about is the fundamentals. Once they realize they're wrong, okay, I was wrong. I don't care about the stock price or the market. I care about fundamentals, value. Value changed, okay, I'm changing course. Advantage number 9. The chance of an investor losing all their money in speculating is way, way, way higher than in value investing. Now, there isn't a pure correlation between this point and speculating, but this is, I believe this is factually true. I mean, I don't know if it was ever done a pure study on this whole thing, but it's common sense, and the reason for that is because a speculator tends to invest their money in more speculative and risky securities, and in more speculative and risky ways. This is a combination of the style of the speculating and the character of the speculator that makes them more makes a bigger chance to lose all their money than a value investor. Advantage number 10. This is hands down, value investing in the long run is more profitable than speculating. It's not just a statistic. It's more like a historic fact. If you take the biggest and best investors in the last century, they were all value investors. Now, I know a lot of speculators will argue, no, it's not true. And they'll say, okay, this is a famous investor and he wasn't a value investor and he compounded at a very high rate throughout his whole career. And first of all, I'll say, okay, even if you find me a few investors like that, no one beats Buffett and Peter Lynch and all these great value investors. And I'll say another thing, that there are a lot of investors who are categorized as speculators, and in essence, they're value investors. The way the mindset works, the way they worked, is more like a value investor than a speculator. But the only reason they're not called a value investor, they're called a speculator, is because they don't work in a classical Graham Buffett style. So they're called the speculators. But they also buy based on value. Just they work a different kind of values. Not the value like that the Graham and Buffett say, but in essence, they're more of a value investor than a speculator. So I'll say even that argument is wrong. But hands down, like I say from experience and from people that I know, value investing in the long run beats speculating. Thank you very much, and I hope you enjoyed this video. Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.